you want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on
Individuals, advisors and institutions.
It's been a very busy week on the UK market from earnings releases from major companies across the UK. We're going to take a very quick look at some of the key sectors reporting this week. That's the pharmaceutical sector, the energy sector and the communication sector. So, starting off with pharmaceuticals, AstraZeneca shares suffered this week after announcing a 28% drop in earnings due to higher marketing costs. Morningstar expects the largely flat top-line growth seen in the fourth quarter to reflect the firm's growth prospects over the next 3 years. Trading at £46, the Astra shares are currently much higher than our £34 fair value estimate, meaning it's just got 1 star from Morningstar analysts as we think it's overvalued. GlaxoSmithKline, meanwhile, reported earnings that were much more in line with our expectations. On the plus side, we like that it's enjoying strength in its portfolio of branded drugs and it's becoming more competitive in the vaccine and consumer health businesses. But on the downside, not only is the pricing environment deteriorating for its key respiratory franchise, but we're concerned that any slip-ups in its vaccine or consumer health businesses would probably lead to a dividend cut. Trading at just below our £15.10 fair value estimate, we think the shares are roughly fairly valued and therefore they have a 3-star rating from Morningstar. Moving on to the energy sector, the main news from BP this week was that it slashed its capital spending budget to $20 billion in a move to prepare for oil prices staying low throughout 2015 and beyond. Morningstar believes that, quite frankly, 2015 is going to be a bit of a shocker for BP, but its relatively strong financial position means its dividend is safe in our view and its legal issues are manageable. BP shares are trading around £1 below our £5.75 fair value estimate, so they get a 4-star rating because they're slightly undervalued in our view. BG, meanwhile, also reported a slashing of its capital spending budget to $6 to $7 billion, and at the same time announced earnings that came in broadly in line with our expectations, including operating profit down 36%, partly due to the lower commodity prices. Management's guidance was a touch on the weak side in our view, but our analysts believe that management may be erring on the side of caution, having previously disappointed the market by failing to meet its own guidance. Trading at just £10 at the moment on the FTSE 100, which is well below our Morningstar fair value estimate of £14, BG shares have a 5-star rating at the moment, one of the few UK companies to have such a rating, because we think the shares are significantly undervalued. Moving on to telecoms and communication, there's been a fair amount of news this week, not just in earnings, but also in M&A. Sky reported impressive subscriber growth, with strong growth in the UK and Ireland in particular, as well as Germany, Austria and Italy. Morningstar doesn't expect this subscriber growth to remain this strong, but we do think Sky can continue to expand its base, regardless of what BT and other competitors continue to try to do to harm it. Shares responded well to the news, meaning that they're still trading above our £8.80 fair value estimate, and therefore we think they're slightly overvalued. Moving on to BT, M&A news had BT shares soaring on Thursday. It was the best performer on the FTSE 100 after confirming the details of its deal to buy mobile network EE for £12.5 billion in cash and shares. We think the deal makes a lot of strategic sense, and though we expect it to take about a year to get regulatory approval, we do expect the deal to go through. A steep rise in the shares following the news took it to well above our £3.17 fair value estimate, but we still think that's what the shares are worth. Last but not least, Vodafone reported earnings this week and shares tumbled 2% following the news. Its third quarter sales leave the firm a bit behind the trajectory needed to meet our expectations for the full year, but we do think trends are moving in the right direction. The share price drop this week brought the shares closer to our £2.18 fair value estimate, but we still think they're a bit overvalued. This was the main earnings news this week from those 3 key sectors. For more news and Morningstar analyst response, check out morningstar.co.uk. Thanks for watching.